Reporting Standards with me, John Bone. Okay, let's have a look at our first LOS, asking us to describe the objectives of financial statements. And this is rather nice because it's a complete repetition of an earlier LOS. And remember, earlier we looked at the International Accounting Standards Board conceptual framework, and we pointed out that accounts essentially should be useful to the providers of finance. So in other words, investors, lenders and other creditors. And of course the accounts therefore should help in their decision making about providing resources. So whether to buy equity, whether to hold equity, whether to offer the loans, whether to call back loans. Okay, our next LOS asks us to describe the roles and desirable attributes of standard setting bodies and regulatory authorities. So what we're going to start off with here is an overview of the system, if you like, in the US. Now you can see the major standard setting body for accounts in the US is the FASB, that's the Financial Accounting Standards Board in the US. And you can see they have two things. They issue statements of financial accounting concepts. In other words, this is the framework, the principles that allow you to generate the accounting standards. And then of course they issue the accounting standards themselves called SFASs, Statements of Financial Accounting Standards that apply to specific transactions. Notice both the American Institute of Certified Public Accountants, i.e. CPAs, and also the Securities Exchange Commission recognize the accounting standards body. Now remember, it's the AICPA that is essentially going to form the auditing bodies. So in other words, for them to form an opinion that your accounts are true and fair, you're going to need to comply with the Accounting Standard Board's SFAC and SFAS, and also if you're a listed company, then of course you're going to be regulated by the SEC. So the SEC is again saying, look, you need to apply the concepts and standards of the accounting standards body. We have two major accounting standards bodies that we encounter in our syllabus. One is, of course, the US, which is the Financial Accounting Standards Board, as we said on the previous slide, and one is the International Accounting Standards Board, which covers most other countries these days. You should be aware in the exam that you're meant to assume international accounting standards unless told otherwise within a question. So unless they say US GAAP, assume you're looking at IAS. So here, remember, we were asked to describe the desirable attributes of our standard setters. So here they are. They should have high professional standards. They should have adequate resources and competencies to accomplish their mission in terms of resourcing, in terms of producing the standards and ensuring that they promote a true and fair view of economic substance of transactions. They need a clear and consistent standard setting process. So in other words, how standards are generated from consultation through to drafting, redrafting, and then the final completed accounting standard coming into force. They need to be guided by a well-articulated framework. Now the frameworks are the key principles that are used to generate the accounting standards. And we're going to have a look at the framework for international accounting standards in just a little while. They need to operate independently, so we're saying really they should be free from bias, while seeking input from the key stakeholders. So who are the key stakeholders they're going to be talking to? The firms that of course are producing the accounts, the shareholders that are relying on that accounting information, things like the SEC of course, in other words the listing regulators, etc. They shouldn't be compromised by special interests. In other words, their goal should be to show the economic substance of transactions, and they should not be compromised by special interests, whether those are the interests of the firms themselves or key groups of shareholders, etc. And finally, of course, decisions made in the public interest result in standards adopted by the regulatory authorities. It's all about presenting accounts that are true and fair and reflecting economic substance. Okay, just be aware of a few of the other regulators that we may encounter. Be aware of the SEC. Remember, they're the listing authority in the US. The Financial Services Authority, they're the listing authority in the UK. And also, we've got this body called IOSCO, the International Organization of Securities Commissions. Let's have a look at IOSCO now. Notice IOSCO has 181 members and it covers 90% of the world's capital markets. It includes each market's regulator, primary regulator, so the SEC in the US, the FSA in the UK, for example. Now again, I think what you need to know here are what their three core objectives are. Remember, they're talking about global financial markets these days. So what they're really trying to arrive at is one set of rules that will apply to all customers in financial markets. So their core objectives are, number one, ensuring that investors are protected. So in other words, ensuring that an investor with little knowledge of the financial markets is protected in the transactions that they undertake, buying investment products. Ensuring that markets are fair, transparent and efficient. So fair, no one is prejudiced in transactions. Transparent, of course, means, information is readily available, details of trade publications, things like that. And efficient markets. Now, of course, we talk about efficient markets in our equity. Efficiency is all about the level of information contained in the share price. So we want, therefore, the share price to reflect all available information. And then their final goal is to reduce systematic risk, i.e. the fluctuations caused by the business cycle in global financial markets. Okay, now you may argue, given that we've just been through the biggest crash in global financial markets, that they're some way away from achieving objective number 3. Let's have a look at some SEC filings and forms. Again, whether you'll be tested on these in detail is rather a moot point, but to err on the side of caution, we thought we'd cover them anyway. Notice whenever a firm issues new shares to the public in the US, then they have to file the details of those shares, i.e. the prospectus, detailing the features of the shares, the details of the company, in Form S1. The annual reports need to be reported in Form 10K. The quarterly reporting for listed firms is in Form 10Q. Remember, we said earlier that every time there is a shareholder vote, then proxy statements must be filed, and those are filed in 14A, Def 14A. And remember, those proxy statements detail the up-and-coming vote, what the issues are and what people will be voting on. Form 8K is a really important form for the analyst to look at because it details any material events. Typically, the listing authorities for firms globally want to ensure that all information is quickly built into the share price. Therefore, any material events affecting the company need to be publicly released, and this is the form that the firms use to notify the SEC of material events. So what kind of things are we talking about here? Major acquisitions and disposals, changes in management, so appointment of directors, removal of directors, other corporate governance issues such as appointment and removal of auditors, etc. Form 144 is stock issues to qualified buyers without SEC registration, so the shares don't need to be registered. Typically, you're likely to pick up on transactions with corporate insiders here. And then Forms 3, 4, and 5, these are share dealings with corporate insiders, so in other words, key shareholders in the company and also key management within the company. Okay, our next little LOS asks us to describe the convergence between International Accounting Standards Board rules and the US GAAP rules, the FSAB rules. Now, the idea, of course, is they're converging, trying to reduce the differences between worldwide accounting standards. Why? Because we're working in global markets these days, so you have companies that are operating in different markets and you have investors operating in different markets. So let's have a look at the 3 major reasons then. Number 1, increase in comparability. So in other words, you should be able to compare the results of a firm operating, let's say, in the UK and the results of a firm operating in the US. If they have the ability to choose different accounting standards, that's going to reduce that comparability. Now, of course, you also want to decrease the problems and expense of raising capital in foreign markets. Let's imagine you're a UK firm producing your accounts in the UK. If you go for a US listing, then, of course, you might then have to produce your accounts under US GAAP. So, essentially, you'd need to produce accounts in your domestic currency and using your domestic regulators' rules, and then also in the overseas country using their rules where you're listed. Now, of course, if we have one set of rules, then it's only one set of accounts for both. And in fact, we're already working towards this. These days, if you produce your accounts under International Accounting Standards and you go for a listing in the US, you don't actually have to reconcile your accounts between IAS and US GAAP. Third point is decreasing the problems and expense of preparing consolidated financial statements for foreign subsidiaries. Now this is really looking at multinational organisations and arguing that they have companies dotted around the world. Each of those companies, of course, has to produce their accounts in accordance with their local regulators' rules. Now what that means then is when you produce the group accounts in your domestic currency, you're going to have to convert all of those overseas accounts. You're going to have to convert them to your group accounting standards before you produce the consolidated accounts. What barriers? What is actually preventing convergence? Number one, differences in views between standard setting bodies. And we get quite a lot of this. So for example, at the moment, International Accounting Standards does allow you to revalue things like PP&E and intangibles, but US GAAP doesn't. So there's a difference in view in the treatment. Second point is pressures from business and industry groups. So in other words, maybe there's some bias creeping in to those accounting standards. Now remember we said really the desirable characteristics of a standard setter is that they avoid any biases caused by business and industry groups. And then finally, you've got many different countries involved, and whenever you've got lots of different people with lots of different points of view, it takes time to reach a consensus. Now let's turn our attention to describing the IFRS framework, which is our next LOS. So first things we need to be aware of are that there are two qualitative characteristics, and these are relevance and faithful representation. Let's start off with relevance. Okay, relevance, and it goes back to the objective of financial statements, and that is to provide information that is useful for making economic decisions. So let's have a look at our point. So this information included in the accounts should influence the user's economic decisions or evaluations of past events or forecasts of future events. Okay, fairly straightforward. So it's useful for economic decision making. So the information in the account should have a predictive value. It should be useful for predicting the future, and of course we do exactly that when we calculate price-earnings ratios. We look at the share price as a multiple of future earnings. And of course we use the accounts as well as a basis for reducing free cash flows for valuation purposes, etc. So in terms of equity valuation, we do use financial statements for their predictive value. Also, notice not only should it have a predictive value, but it should have a confirmatory value as well. So in other words, it should be able to confirm our prior expectations of the firm, whether they were expectations of earnings growth, cash flow growth, dividend growth, etc. Notice materiality as well is an aspect of relevance. Remember, essentially, all material transactions should be reported accurately, i.e. should represent their economic substance in order for the accounts to be true and fair. Remember, a material transaction is a transaction that is significant enough to affect the opinions of the users of the accounts. Let's turn to our second of our qualitative characteristics, and that's faithful representation. So for the information to have faithful representation, it should be complete, meaning it covers all transactions that the firm has entered into over the period. It should be neutral, so there should be no biases, i.e. it should represent the economic substance of the transactions. And then finally, they should be free from error or free from material error. So let's have a look at our characteristics. Comparability, meaning the same accounting principles have been used to calculate this year's results and also the comparative data in the accounts. Remember, you need to show comparative data, i.e. this year's and previous year's results for your income statement, your balance sheet, your cash flow statements, for example. So comparability just says, look, the data needs to be prepared consistently year on year. Verifiability means essentially the data, the figures in the financial statements can be audited. So they should be verifiable. Timeliness is talking about the idea that the accounts are produced promptly after year end, and it's due to the basis that economic data or financial data goes out of date very, very quickly and loses its value for making economic decisions. So the quicker the accounts are produced, the more value they have for economic decision making. And then finally, our last point is understandability, which is really saying a reasonable user of the accounts, i.e. somebody with reasonable understanding of financial statements, should be able to understand the transactions and therefore the economic position of the company by looking at their financial reports. Now, of course, it's ideal to have all of these characteristics, but in reality we have trade-offs. And one classic trade-off we have is between relevance and verifiability. Now, relevance, remember, says get those accounts out on a timely basis. Okay, in other words, get them out of the door as quickly as you can, because economic data loses its value for decision making quickly. Whereas verifiability would say, if we wait a long time after the year end, we'll have more information to establish the accuracy of the year end balances. Let me give you an example. If you're looking at accounts receivable at year end, you will have a greater idea of the collectability of those accounts receivable by waiting after year end and seeing whether the customers have actually paid you. However, by waiting a long time after the year end, then of course the economic data contained in the accounts is less relevant to decision making because it's less timely. Benefits versus costs simply say the benefits of producing the accounts should outweigh the costs of producing them. And then finally, our last point is really saying, look, the financial statements themselves only include quantifiable information, i.e. the information that we can put monetary values on. Therefore, the financial statements themselves exclude non-quantifiable information. Remember, you will find non-quantifiable information, but largely in the management discussion and analysis. And remember, that of course is not audited. Okay, we're asked now to describe the general requirements of International Accounting Standard number 1. Okay, so let's have a look at our box here. An item should be recognized in its, i.e. the firm's financial statements, elements, if a future economic benefit from the item flowing to or from the firm is probable and it can be measured reliably. So our key words to take away from this, in order to include something in the accounts, it needs to be probable, and you need to be able to measure it reliably, i.e. put a dollar figure on it. Okay, now let's apply those rules when we're looking at the balance sheet. So IFRS requires us to report in the balance sheet assets, liabilities and equity. Let's have a look at their definition of an asset. Well, an asset is a resource controlled by the entity resulting from past transactions. And here's the key point: it will lead to a probable future economic benefit flow to the enterprise. So let's take, for example, our accounts receivable, which are an asset in the balance sheet. How do they lead to a future economic benefit? Well, hopefully the customer pays you and cash comes into the company. Liabilities, however, are obligations resulting from past events. So these are going to lead to probable resource outflow when they're settled. So let's take our accounts payable, the amounts that we owe our suppliers. How do they lead to an outflow? Well, of course, when we pay them, when we pay our suppliers, cash leaves the business. Notice we define equity as the shareholders' residual interest, the stockholders' residual interest. In other words, going back to our balance sheet equation, assets equal liabilities plus equity. If we rearrange that, we get assets minus liabilities equals stockholders' equity. So in other words, take your assets, deduct your liabilities, anything left over, well, that's what belongs to our stockholders. Let's turn our attention now to the income statement under IFRS. Well, they require us to report both income and expenses. Notice the definition of income are increases in economic benefits. So this could be enhancement of assets, so increase in asset values, decrease in liability values, or revenues and gains in the income statement. Note the key here is they increase stockholders' equity. So really we're looking for increases in stockholders' equity other than issuing new shares, other than essentially buying back shares and paying dividends. Likewise with expenses, we're looking at decreases in economic benefits. So outflows or depletion of assets, increases in liabilities, or expenses and losses in the income statement. The significance, therefore, are these represent decreases in stockholders' equity other than the repurchase of equity and the payment of dividends. So let's have a look then at the general requirements of International Accounting Standard number 1. First of all, what financial statements is the firm required to produce? Well, we've looked at all of these before. The balance sheet, the income statement, the statement of comprehensive income, the changes in stockholders' equity, the cash flow statement, and then of course the footnotes including the accounting policies all need to be produced per the accounting standards. Now, what principles should be applied when producing those accounts? Number one, fair presentation, and therefore this is saying that the financial statement should represent the economic substance of transactions undertaken. Number two, going concern should be applied when producing the accounts. What does this mean? It means the company is deemed to continue for the foreseeable future. If you disapply going concern, then the accounts would look very different. You'd have no long-term assets in the balance sheet because there is no long-term for the company. Everything would be a current asset. Same with liabilities. You would have no long-term liabilities if you disapply going concern. Why? Because there is no long-term for the company. Accruals basis just means essentially we prepare the accounts using accruals rather than cash accounting. Cash accounting would record transactions essentially when cash flows are exchanged between two counterparties, whereas accruals basis records revenues when they're earned rather than when cash is paid from the customer, and it matches costs against revenues if that's applicable, or alternatively costs against time. Consistency simply says once we produce our accounts and we've selected our accounting principles, we should apply them consistently year on year, and that way our comparative data is comparable to this year's data. And then of course the final point is materiality, and this is really saying the correct accounting treatment must be applied to all material balances for those accounts to be true and fair. Let's have a look at our presentation requirements. Aggregation where appropriate. So for example, in our balance sheet, we'll just show one line for accounts receivable, the amounts that we owe our customers. We're going to aggregate all the amounts that customers owe us and show it in one figure, rather than showing what each customer owes us as a separate line. Okay, so we should aggregate where appropriate, aggregate by the characteristics of the transaction. No offsetting. This is really saying no offsetting in particular between assets and liabilities. So for example, you've got a bank account that has positive cash in it and another bank that has negative cash in it. In other words, an overdraft, for example. Now, if those two accounts were held with different banks, you would not be allowed to net them against each other. Okay. So you're not allowed to offset unless the accounting statements say you can offset assets and liabilities. Another good example of this is when we've got deferred tax assets and liabilities. Rather than showing the net position, we need to show the deferred tax asset separately and the deferred tax liability separately. Our third bullet point says produce a classified balance sheet where we're going to group transactions together according to characteristics. So we'll often have long-lived assets, and then we'll have current assets, we'll have long-term liabilities and current liabilities. The accounting standards also show you the minimum information that needs to be disclosed on the face of your primary statements, and as a result also the minimum disclosure that you need to show in your footnotes. And of course we also have a requirement to produce comparative information. In other words, we don't just produce this year's balance sheet, but we show it next to last year's balance sheet. Same with the income statement. Why? To allow analysts to make comparisons between years. Which of course then goes back to the idea that if you're going to make comparisons between this year and the comparative information, you need consistency, knowing that those accounting policies have been applied consistently year on year. There is just one other point I'd like to add that isn't on the slide, and that is reporting frequency needs to be at least annually per IAS 1. Our next little LOS says compare the differences between the frameworks of IFRS and US GAAP, and the reality is there are relatively few these days. Notice International Accounting Standards frameworks list income expenses as elements related to performance, i.e. income statement items, whereas US GAAP says revenues, expenses, gains, losses and comprehensive income. Also notice US GAAP defines an asset as an economic benefit, whereas International Accounting Standards Board says it is a resource from which an economic benefit is expected to flow. Okay, notice as well the use of the word probable to define assets and liabilities. Another key difference that we have is the idea that US GAAP doesn't tend to allow the upward revaluation of assets. So in other words, most assets in the balance sheet under US GAAP are sitting there at historic cost. There are some differences, there are some exceptions to this, in particular with marketable investments. Then certain marketable investments under US GAAP can be held at their fair value rather than historic cost. International accounting standards tends to be far more flexible in terms of allowing you to report fair value. You can do it not only for marketable securities, but you can also do it for all of your PP&E and your intangibles as well. Okay, identify is our next LOS. Identify the characteristics of a coherent reporting framework. So here they are. Here are our three: transparency, comprehensiveness, and consistency. Transparency is simply saying that the account should reflect the economic substance of transactions. There should be full disclosure and fair presentation. So all transactions are covered and all transactions are reported showing their economic substance in the accounts. Comprehensiveness just says essentially all financial transactions are covered by the accounts. As a result, if there is a new transaction that is not covered by an existing accounting standards, then you should go back to the reporting, the framework that we talked about, and use those principles to work out how it should be accounted for to show economic substance. Consistency then says transactions should be measured and represented in a similar way across companies and across time. Again, this is to allow comparability between companies. However, notice we need sufficient flexibility to show economic substance. So in other words, there's got to be a lot of choices in accounting principles, and therefore the firm should choose the accounting principles that allow them to reflect economic substance. Problem is, of course, whenever we have choice, that is going to reduce comparability between firms, and of course it could be exploited in terms of earnings management. What are our barriers? We need to explain the barriers to a single framework, and we've got three: valuation, standard setting, and measurement. Now, as we said, under US GAAP, most of the balance sheet is sitting at historic cost or amortized historic cost. Now, historic cost is just the cost when the transaction took place originally, so when you bought an asset, for example. Now, the benefit it has is there's very minimal judgment here. Okay, why? Because the auditors can confirm it by checking the invoice for when you bought the asset, for example. So it's very reliable. Problem is, it isn't necessarily particularly relevant because historic cost may be very different from economic value of an asset or liability. So the alternative, of course, to historic cost is to report items at fair value, i.e. their current market value or their current economic value. Problem is, unless there's an actively traded secondary market for the asset or liability, it's going to require considerable judgment. Okay, so the beauty of fair value is it allows us to show the economic value of an asset. The disadvantage is, of course, there's judgment involved. Notice both US GAAP and International Accounting Standards say some elements should be measured at fair value. Remember, they're consistent in saying that marketable investments should be recorded at fair value. However, there's inconsistency between the two in our PP&E and our intangibles. International Accounting Standards saying you can record at fair value. US GAAP saying use historic cost, or historic cost net of accumulated depreciation. So let's have a look at our standard setting methodologies. Really, we have principle-based, rules-based, or objectives-based. Principle-based means there are very few specific rules talking about specific transactions. Instead, what you do is you have broad-based principles as laid out in the framework that we just looked at for International Accounting Standards. And by applying those principles, by definition, the firm should end up reporting economic substance of the transaction. Rules-based approaches, and US GAAP used to be very much a rules-based approach, means essentially you will follow set rules to record set transactions. The problem is you can end up following a rule that doesn't show economic substance. And of course that's exactly what happened under US GAAP, leading to the kind of Enron fiasco. So we've seen US GAAP moving from rules-based to more objective-based. And both International Accounting Standards and US GAAP are objective-based, where they combine principles set out in the frameworks and rules governing specific transactions. Our last point here is measurement, of course, and there are two broad approaches. Either we can focus on getting the balance sheet correct, in which case the income statement is rather an afterthought, it just falls out from the balance sheet, or alternatively we can focus on getting the income statement correct, in which case the balance sheet becomes an afterthought. Why is this the case? Why can't we focus on both simultaneously? Well, it's because of the process of double entry bookkeeping. Okay. In other words, a standard that affects one of the financial statements by definition will affect the other, and they may conflict. Currently, both US GAAP and International Accounting Standards take a balance sheet approach, so that they focus on getting the assets and liabilities right, and as a result, the income statement rather falls out of this. Okay, we need to explain the importance of monitoring development in accounting standards. Well, of course, we've already said accounting standards are evolving rapidly due to primarily the convergence process between IASB and US GAAP. So, of course, we need to know how the accounting standards are changing, because that affects how transactions are reported in the accounts, and as a result it affects things like the ratios that we calculate. So the analyst's focus is the impact of changing accounting standards on the financial reports, how it affects earnings, how it affects figures in the accounts, how it affects ratios, for example. So the analyst needs to monitor any new products and transactions that the company enters into, and then look to see what accounting principles are being used and whether the analyst believes that that supports the economic substance of the transaction. The analyst, of course, needs to look and keep an eye on changing accounting standards, and of course, in order to do that, we need to look at how our regulators are changing these standards themselves. So you'll need to take note of the International Accounting Standards Board and the Financial Accounting Standards Board in the USA to pick up changes in the accounting standards. Notice as well that the CFA Institute has the Center for Financial Market Integrity that also details changes in standard setters and principles. Of course, be aware as well that the analyst should be reviewing company disclosure, because of course if a company changes its accounting principles, it should be detailed in the footnotes. Notice the footnotes will detail the accounting principles that have been used to account for the material transactions in the accounts. Management discussion and analysis in particular will talk about whether there have been changes to accounting principles and the rationale behind them. And that takes us rather nicely to our last learning outcome, which is to analyze company disclosures relating to accounting policies. Now remember, critical and significant accounting policies should be set out in the footnotes, because the analyst needs to know exactly how that balance sheet and income statement has been prepared. Not only should it set out the accounting principles that have been followed, but also, of course, any accounting estimates that have been used in arriving at the figures in the balance sheet, income statement, cash flow statement, for example. Changes in accounting policy, again, will be disclosed in the company's footnotes, but as well, remember, not only is the footnote disclosure, but there's discussion of the rationale behind changing the accounting principle in the management discussion and analysis. Now, of course, there may be a change in accounting principle because it's required, because the standard setting bodies have changed the principle, or it may be that the company believes that by changing the accounting principle, they're better able to reflect the economic substance of the transaction. So what should the analyst focus on? What policies are being discussed in the management discussion and analysis, and how they affect the financial statements? Are the policies that are disclosed in the footnotes to the accounts, do they cover all significant material transactions? What balances in the financial statements require estimation, and are those estimates reasonable? And of course, have there been changes to accounting principles or accounting estimates year to year?